Your investments won't make you rich if your debt is getting there first. Every payday, millions of people make the same decision. Some send an extra $500 to their investment account. Others send that same $500 toward their credit card. Both feel responsible. Both believe they're building a better future. But only one decision is usually doing what they think. Here's what almost nobody tells you. The stock market has historically returned about 10% per year on average over the long term, but those returns are never guaranteed, and some years are negative. Meanwhile, many Americans carrying credit card balances are paying interest rates around 20% or more. That creates a problem. If your investments earn 10%, but your debt is costing you 20%, are you actually moving forward, or are you trying to fill a bucket with a hole in the bottom? Today, we're going to run the real math. Not to shame anyone for having debt, not to tell you investing is a bad idea, but to answer one question that could save or cost you thousands of dollars over your lifetime. Should you invest first or eliminate high-interest debt first? Because the answer isn't based on motivation, it's based on math. Imagine two friends, Emily and Daniel. Both receive an unexpected $500 bonus. Emily opens her brokerage account. She buys an S&P 500 index fund. She smiles. She feels like an investor. Daniel does something much less exciting. He logs into his credit card account and makes a $500 payment. No screenshots, no investing app, no celebration. Just a smaller balance. If you asked most people which one is building wealth, many would point to Emily. After all, investing is how you grow money, right? But here's where our brains play a trick on us. We can see investments growing. We get notifications, green numbers, portfolio charts, annual returns. Debt doesn't give us that feeling. Paying off debt doesn't look like progress. It looks like money disappearing. Psychologists call this loss aversion. We naturally feel the pain of giving money up more strongly than the satisfaction of reducing an invisible obligation. That makes investing feel emotionally rewarding, while debt repayment often feels unrewarding, even when it improves your financial position. That's why millions of people invest every month, while carrying expensive credit card balances at the same time. And that's where the real math begins, because your credit card company doesn't care whether the stock market has a great year. It keeps charging interest anyway. Let's run the numbers. Imagine you have $10,000 in a credit card balance with an APR of 20%. Now imagine you also have $10,000 sitting in an investment account. You have two choices. Option 1, leave the debt alone, keep investing every month, hope the market grows faster than your interest. Option 2, use the money to eliminate the debt, then begin investing with the payments you no longer owe. At first glance, investing seems smarter. After all, the S&P 500 has historically returned about 10% annually over long periods, although those returns are never guaranteed and can vary significantly from year to year. But here's the problem. Your credit card interest isn't historical. It's happening today. And unlike the stock market, it's guaranteed. If your card charges 20% APR, every dollar you pay off effectively saves you interest at that rate. There are no bad market years, no downturns, no uncertainty. Every dollar of high-interest debt you eliminate is a guaranteed improvement to your financial position. Think about that for a second. Investing offers the possibility of future returns. Paying off expensive debt removes a guaranteed cost. Those are not the same thing. Here's an easier way to picture it. Imagine two buckets. One bucket is your investments. The other is your debt. Every month you pour water into the investment bucket, but the debt bucket has a hole in it, and it's leaking twice as fast. You can keep pouring, but until you patch the leak, you'll always wonder why the bucket never fills. This is where many people get trapped. Investing feels productive. Debt repayment feels invisible. One gives you exciting notifications, the other gives you a smaller number on a statement. But wealth isn't built by chasing excitement. It's built by improving your net worth. And net worth doesn't care whether your money is growing or your debt is shrinking. It only cares about the difference between what you own and what you owe. That's why many financial planners recommend eliminating high-interest credit card debt before aggressively investing. Not because investing is bad, because a guaranteed 20% savings is extraordinarily difficult to outperform consistently with investments over time. But before you cancel your automatic investment contributions, there's an important exception. because there are situations where paying off debt first isn't the smartest move, and understanding that difference could save you far more than blindly following either rule. But here's where most financial advice becomes too simple. You'll often hear people say, never invest until every dollar of debt is gone. It sounds logical. It sounds responsible. But it isn't always correct, because not all debt is the same, and not all investments are the same. Here's the first exception. Imagine your employer offers a 401k match. For every dollar you contribute, they contribute another dollar, up to a certain percentage of your salary. That's an immediate 100% return on the money you contribute before your investments have even had a chance to grow. Very few financial decisions offer an opportunity like that. So if you're skipping your employer match just to pay down debt, you could be walking away from free compensation. That's why many financial experts recommend contributing at least enough to receive the full employer match, even while aggressively paying off high-interest credit card debt. After that, directing extra money toward eliminating expensive debt is often the better mathematical choice. That's the nuance. Financial advice is rarely all or nothing. Now let's look at another exception. Suppose your debt isn't on a credit card. Suppose it's a fixed-rate mortgage at 3%, or a low-interest student loan. Now the math changes. A 3% borrowing cost is very different from a credit card charging nearly 20%. That's why this isn't really a debate about debt versus investing. It's a debate about the cost of your debt. The higher the guaranteed interest you're paying, the harder your investments have to work just to break even. And that's exactly why credit card debt is so dangerous. It's not because debt is evil, it's because the interest rate is working against you every single day. There's another psychological trap almost nobody talks about. People often separate their money into different mental accounts. They'll proudly say, I'm investing every month, while quietly carrying a large credit card balance. Psychologists call this mental accounting. Your brain treats your investments and your debt as two separate stories, but your net worth doesn't. It combines them into one equation. Money doesn't care which account it's sitting in. It only cares whether it's moving you forward or holding you back. That's why real wealth isn't built by collecting investment accounts. It's built by increasing the gap between what you own and what you owe. And sometimes, the fastest way to become a better investor is to stop investing for a little while, because eliminating a guaranteed 19 to 20% borrowing cost can be one of the highest risk-adjusted financial decisions available to most households carrying revolving credit card debt. But that still leaves one final question. If paying off debt is usually the better move, why do so many intelligent people keep investing anyway? The answer has nothing to do with mathematics. It has everything to do with human psychology. So why do smart people keep investing while carrying expensive credit card debt? Because investing feels like progress. Paying off debt feels like giving something up. One creates excitement, the other creates relief. And our brains are wired to chase excitement. It's the same reason people celebrate buying a new car, but rarely celebrate making the last payment on an old one. One is visible, the other is freedom. Here's a question that changed the way I think about money. If someone guaranteed you a 20% return with no market risk, would you take it? Most people would say yes. But if you're carrying a credit card balance with a 20% interest rate, that's exactly what eliminating that debt is doing. You're removing a guaranteed cost that compounds against you every single month. No market prediction, no market timing, no hoping, just math. Now, does that mean you should never invest until you're completely debt-free? Not necessarily. Remember the exception. If your employer offers a 401k match, capture the full match first. It's one of the few opportunities where you're receiving immediate additional compensation. After that, every extra dollar deserves one simple question. Where will this dollar work the hardest? If it's earning a guaranteed benefit by eliminating high-interest debt, that's usually where it belongs. If your expensive debt is already gone, that's when investing becomes the engine that builds long-term wealth. This isn't really a choice between debt and investing. It's a choice between certainty and possibility. Paying off high-interest debt gives you a guaranteed improvement. Investing offers the potential for future growth. The order matters because every financial decision has an opportunity cost. The goal isn't to own the biggest investment portfolio. The goal is to build the highest net worth. And net worth grows fastest when you stop paying unnecessary interest before chasing uncertain returns. Because real wealth isn't about making your money look busy. It's about making every dollar work where it creates the greatest impact. That's the math of freedom. If you found this helpful, subscribe to The Wealth Logic.